Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Swan, and in each episode I share my thoughts with you on a topic or a recent development in South African tax. And I try to keep each episode short enough that you can listen to it while you're taking a break from work. Today we are looking at a recent development that affects interest-free or low-interest loans in a cross-border context. More specifically, the scenario that we're looking at would involve a resident individual, or in some cases, a company that's connected to the resident individual, but for simplicity, let's keep to the resident individual to talk about the principle that lends an amount to a foreign connected trust. Or then again, it could be to a company that is connected to or where the shares are held by this foreign connected trust. But to keep it simple, we're looking at the scenario for now. Resident individual lending an amount to a foreign trust. And often you would find that this foreign trust is a foreign family trust. So where the resident and its related persons would hold interests as beneficiaries of that trust. It could be a vested trust, but in most cases it's a discretionary trust where the beneficiaries don't have vested rights to the assets of the trust. Now, if we then look at this, the loan that the resident advances to the foreign trust, there's two provisions that, or at least two provisions of the Income Tax Act that applies, and there could be some overlap between these provisions. And so the recent development relates to how that overlap works. The first provision that we need to take into account is Section 31 of the Income Tax Act. So that provision deals with transfer pricing. And it basically states that where you've got a resident and a related non-resident, so it's either a connected person or an associated enterprise, who deal with each other on terms and conditions that are not what persons dealing at arm's length would have agreed to, and one of them derive a tax benefit from this, often the resident, who would get some sort of a more beneficial South African tax position, then that person needs to make an adjustment under Section 31. And we'll talk about the adjustment just now. So how does the loan between the resident and the foreign trust fit into this scheme of Section 31 that I just explained? So if the resident lends an amount to the foreign trust and doesn't charge interest on this amount, or charges too little interest on this amount, from the resident individual's perspective, that person's taxable income would be understated. So the resident individual would declare less income than he or she would otherwise have declared had they charged an arm's length interest to the foreign trust. So if this happens, that you don't transact on arm's length terms, and the one party, the resident individual, gets a tax benefit, then you need to make a transfer pricing adjustment under Section 31(2) of the Income Tax Act. So what that provision basically requires is a primary adjustment. So in other words, the person who derives the tax benefit must then go and determine his or her tax benefit or taxable income, taking into account what the terms and conditions, if they were dealing with this foreign trust on an arm's length basis, what those terms and conditions would have been. So these arm's length terms and conditions would take into account the credit risk profile, for example, of the borrower, the foreign trust, to determine what an arm's length rate and also terms and conditions as far as things like security would have been. So that's the first adjustment, that the individual's taxable income then increases by the arm's length interest. The second adjustment that follows from this is a secondary adjustment under Section 31, subsection 3 of the Income Tax Act. In the case of an individual who's a resident, that secondary adjustment is deemed to be a donation. So this same amount that was now included in the resident's taxable income is also subject to donations tax. The reason for the secondary adjustment is the fact that you've mispriced the transaction between the connected persons means firstly that your taxable income is incorrect, but also there's been value that's been moved to another person in some way. And if you look at shifts in value without consideration in the context of a natural person, the tax consequence of that would typically be a donation. So therefore, the deemed donation that follows. Now, the provision where there's overlap between Section 31 and that provision is Section 7C of the Income Tax Act. Now, what Section 7C essentially does is if an individual or then a company that's connected to the individual makes a loan to a trust or then a company whose shares are to an extent specified in the legislation held by that trust, and the individual does not charge an interest at the official rate to that trust, or then, as I said, there's scenarios where it could be companies involved, but let's keep it simple for now. The individual advances the loan, doesn't charge interest to the trust, then Section 7C comes into play. And 7C then deems the difference between the interest that was charged and what the interest would have been had it been charged at the official rate to be a donation. Now, this official rate is defined, it's a defined term that we find in the legislation, and it's defined depending on whether the loan is rand or foreign denominated. So you can go and have a look at that definition. Now, because of the overlap between these two provisions, so where the overlap comes in, if an individual advances an interest-free loan to a trust, Section 31 would apply, and Section 7C would also apply. So Section 7C previously had an exclusion that said that if this transaction is an affected transaction that's subject to Section 31, so in other words, if an adjustment was made, then Section 7C didn't apply. The amendment to Section 7C, and this is now the recent development, states that, so the provision has now been amended to say that where that loan constitutes an affected transaction, so one to which Section 31 applies, then 7C does not apply to the extent of an adjustment made under Section 31(2). But to the extent that 7C would have applied and you didn't make an adjustment under Section 31(2), Section 7C would still apply. So let's look at a practical example. Let's assume an individual, a resident, who makes a loan to a non-resident trust, and the parties establish that the arm's length interest rate would have been 6%. The individual doesn't charge any interest on this loan. So under Section 31, this individual is required to firstly make a primary adjustment to include interest at 6% in its taxable income. Following from the primary adjustment, there's also a secondary adjustment to account for the donations tax on the 6%. So that's the value that's shifted to the offshore trust because of the fact that there was no interest. And then, assuming we've got an official rate as defined of 10%, what this amended provision now says is that if you've got a loan that falls within the ambit of Section 7C, which this loan does, then 7C would only not apply to the extent of the adjustment made under Section 31. So 7C would, in the absence of Section 31, have deemed a donation to exist between the 10% that was charged and the 0, or 10% that should have been charged and the 0 that was actually charged. But because you've already made an adjustment of 6% under Section 31, 7C doesn't apply to the 6%, but it does apply to the differential, the 4%. And it would then deem a donation of that additional 4% to arise. If we look at the scenario that's reversed, so the arm's length interest rate is 15%, for example, and the official rate is 10%, then you would make your transfer pricing adjustment under Section 31 for 15%, and because the full 10% that would have been deemed to be a donation under Section 7C is covered by the 15% adjustment, there's no additional top-up effect as a result of applying Section 7C. I think what's important is we've touched on two provisions that affect these kinds of loans. There are also other provisions. So, for example, if you don't charge interest or you've got a low interest loan, that there's case law to support that is a donation, settlement, or other gratuitous disposition. So provisions like Section 7.8 could attribute some of the income earned by that foreign trust back to the resident who advanced the loan on these gratuitous terms. So there's quite a bit to these types of loans. We've only looked at two of the variables in this episode. So I think the take-home message is be aware that there are all these provisions that apply to loans from individuals to offshore trusts, and there's multiple sections to consider, and then to also be aware of the fact that the interaction between Section 31 and Section 7C has recently been amended. And the amendment is really to say that to the extent that 7C would have applied that you didn't make a transfer pricing adjustment, you still need to apply Section 7C for a top-up deemed donation as well. That's all for today's episode. If you enjoyed the podcast, please subscribe on your podcast platform. And of course, tell all your friends and colleagues about the podcast. You are also more than welcome to send me any feedback that you may have or suggestions for future topics that you would like me to speak about. Then I can consider them. My email address is in the show notes to this episode. And just a reminder, as always, nothing in this podcast was intended to be tax advice or a replacement for fact-specific tax advice. Until next time, goodbye.